How to avoid an increase in interest rates on your loans. From a legal point of view, the bank can unilaterally only reduce the loan rate. It can be increased only by agreement with the borrower, by a court decision, or if the borrower refuses to conclude an insurance contract, provided that the obligation to conclude it is stipulated by the contract. However, in reality, banks are using a loophole in the law on the so-called variable rate, which depends on certain external conditions, often formulated extremely vaguely. Within the framework of this opportunity, the right of the creditor bank to unilaterally raise the interest rate is stipulated by many loan agreements. An increase in interest rates can occur completely arbitrarily, without an economic justification and clearly defined limits. You have to find and attentively examine the contracts concluded by you. The details that you remember about them do not matter in the least. Be aware that bank managers very rarely inform the client about the principal, but not beneficial for him, provisions of the documents offered to him. We even had to deal with situations when a bank manager lied to a potential borrower. He explained to the client that no bank's right to a unilateral increase in interest was stipulated in the agreement, and sought to sign an agreement in which this right was directly fixed. Usually, however, everything is more prosaic. This right is entered in small print, either as a note, or as a continuation of an extraneous section of a law that does not have its own meaning, or simply in the form of a link to obscure internal bank documents, the meaning of which is not disclosed in the text of the agreement. Ordinary people, proceeding from the presumption of the good faith of a partner, signed and are still signing such agreements, the meaning of which they do not fully understand and which are capable of simply ruining their lives, in droves. Usually, banks associate a possible unilateral increase in interest rates with an increase in their risks, passing them on to you. The standard reasons are a deterioration in the macroeconomic situation, an increase in the rate of the central bank of the country, or a drop in your solvency. From a liberal, accounting point of view, the bank's logic is flawless. If you do not have the money to repay the loan to the bank, this increases its risks and forces it to insure against them by raising the interest rate. In fact, as is usually the case with banking logic, the principle of global speculators, push the falling one, is effectively implemented. The laws of any country give you legal protection against such actions. Most laws only allow changes in credit conditions in the event of a material change in circumstances. If you challenge the increase in the interest rate in court, the creditor bank will have to prove that, when concluding the contract, both parties did not anticipate such a change in circumstances. Execution of the contract without raising the rate would cause significant damage to the bank, depriving it of a significant part of what it counted on when signing the contract. The increase in the interest rate on the loan was caused by reasons insurmountable for the bank. However, even so, the revision of the terms of the contract is possible only by a court decision. Such a decision is formally possible only if the termination of the contract is contrary to the interests of society, or causes bilateral damage that exceeds the costs of its implementation under the previous conditions. However, the second case concerns the majority of borrowers, since they cannot simply return the money taken earlier to the bank. Borrowers, faced with a choice between improving the credit rate, or the termination of the contract and return all the money, forced to choose the former. You have a legal right to challenge the very right of the bank to include a clause in the loan agreement that allows the bank to raise the loan rate. After signing the loan agreement, you can submit a claim to the bank about the inapplicability of such a condition in the agreement. After his refusal or ignoring you, go to court with a demand to impose a fine on the bank and pay you compensation for causing moral harm. The court may take your side, or it may require you to prove that the provision on the possibility of raising the loan rate was imposed on you by the bank, and you resisted, and that all this led to an imbalance in the interests of the parties. Finally, you can, while recognizing the bank's right to unilaterally raise the loan rate, accuse it of dishonesty and a desire to simply increase your profits. For example, due to the lack of a real economic justification for the rate hike. This method is bad because the global economic crisis is very serious grounds for such actions of the bank. If the bank nevertheless requires payment of the increased interest rate on the loan, it must be remembered that without the agreement you signed to the loan agreement on increasing this rate, this requirement is formally illegal. In this case, you must warn the bank that you will sue him for violating your rights as a consumer and file a complaint with higher authorities. Your task in a relationship with a bank that does not compromise with you is to create the image of an inconvenient victim. This will switch the bank's clerks to other clients who do not defend their rights so vigorously and who cannot hinder its current operations. Naturally, if bank managers give the impression of bandits or use criminals to negotiate, this position is not suitable. Then you need to run from this bank literally at any cost, refinancing in a relatively decent lending institution. If you have studied your agreement and realized that the bank can significantly increase the interest rate at almost any time at its own discretion, then remember that you are in danger and must make every effort to refinance in another bank or repay the maximum part of the loan ahead of schedule. Even if the new loan will be at the same interest rate or a little more, but without the possibility of increasing it. If a fine is provided for this, try to negotiate with the bank managers who, in theory, can meet you halfway. This is due to the fact that the bulk of banks needs cash. If the bank insists on a penalty for early repayment of the loan and refinance, you cannot, then do the following. Compare the amount of the fine with the possible losses from a unilateral increase in the interest rate on your loan by the bank, and choose the lesser of the evils. A special case of an increase in the cost of a loan is if you have a mortgage lending agreement. The agreement may state that your bank has the right to demand additional payments from you in the event of a reduction in the price of an apartment or house. If there is such a point, the most reasonable thing for you is to find a bank that continues to issue mortgage loans without such conditions. Try to re-mortgage an apartment or house in a new bank by repaying an old loan. However, raising interest rates in this case may be overwhelming for you, and banks may not show interest in such an operation. In this case, you will have to act as described in the next video, the correct early repayment of a part of the loan. Subscribe and stay with us. In the next video, you will learn how to reduce the interest on the loan during the crisis.